Warren Buffett's favorite company, Coca-Cola, has been crashing down, just down 5% last week. Now, today's episode, we want to understand why is Coke performing badly over the last few days, and is it a buy now? We're going to look at the historical performance of the Coca-Cola company, understanding if this is currently a cheap price in the market with a strong forward yield for Coke of 3.5%. We're going to jump into their income statements, looking at their top line growth year on year, as well as the bottom line net income. We're going to look at the health check of the company's balance sheet, their total cash versus total debt. We're also going to look at the performance of the Coca-Cola company versus others in the consumer staples industry, such as Pepsi and Dr. Pepper. And as always, this is going to lead us into that all-important dividend safety, understanding some very important financial metrics you need to know before investing in Coke or as an investor. And as always, we will run it through our stock valuation model, getting to our intrinsic value and our acceptable buy price given our margin of safety. Now, before we look at the historical performance, let's just try to understand why this stock has sold off last week around 5%. And it's not just the Coca-Cola company, but it's also Pepsi as well. So the main reason for this, as we can see here, concerns over that the weight loss drugs like Ozempic and Wegovy, if you haven't heard already, are leading customers to buy fewer groceries and consume fewer calories. Now, personally, my own opinion of this, I don't see this affecting companies like Coca-Cola or Pepsi at all. But if we see here in terms of the news, it did prompt a sell-off of 4.8% for Coke and 5.2% for Pepsi. The way I see it, this was an overreaction by the market in my personal opinion. But if you look at companies like Walmart, which typically sell products of both Coke and Pepsi, what they are saying based on the data they are seeing, that effectively they are noticing sales and consumer habits slightly different than those who haven't taken the drugs. And given it's becoming more popular, they are sensing a decrease in sales from Coca-Cola and Pepsi in the near future. Now, personally, again, it really depends on how you see this and the headwinds, as we can see here. Some people believe these drugs to become serious headwinds for these companies, especially for people moving into more healthier products. As we can see, though, Coca-Cola for many years have been moving into healthier beverages. So again, it really depends on how you see this news and what you believe. Personally, I see this as an opportunity to acquire shares of companies at better prices. Now, historical performance of the Coca-Cola company, it's had a horrid year, down 16%, with the S&P 500 up around 15-16% itself. So it has significantly underperformed. It is towards the 52-week low, as we can see. And again, a very strong forward yield. And as I always say, we want to understand, can we lock in a cheap price as well as a strong yield to see both the price double over the next few years and see our yield on cost go into the double digits? So in terms of the company itself, their revenues growth year on year, what we typically look for, 3 to 7% on the top line. December 2018, 34.3 billion. Latest annual report 5 years later, December 2022, 43 billion. So nice growth over the last 5 years. One thing to draw your attention to though, 2018 to 2019, there was some nice growth on the top line. 2019 to 2020, we saw a big drop on the top line, but then it did recover well over the following years. So slight inconsistencies there on the top line. It's not an increase every single year, and we will touch upon the last 10 years percentage-wise soon. Bottom line net income, 6.4 billion, December 2018. December 2022, 9.5 billion. So again, some nice growth, around 50% over the last 5 years. But again, on a more granular level, what do we see? 2018 to 19, we see some strong growth. 2019 to 2020, we in fact see a decrease. And then it does pick up again in 21. But then we can see it has fallen again slightly. So some small inconsistencies just to be aware of with the income statement. It's not smooth sailing. It's not increase after increase on both the top line and short line. So in terms of the balance sheet, let's look at the health check very quickly. Well, total cash in 2018, 16 billion. So cash and short-term investments. Latest quarterly report, fairly flat, hasn't really moved much, around 15.7 billion. So with the cash remaining relatively flat numerically and directionally, how does that compare to the total debt? So total debt, 44 billion. in 2018. Latest quarterly report around 43.2. Again, a small drop there, but relatively there hasn't been much movement in either the cash or the total debt of the Coca-Cola company. Now, before we jump into the supporting financial metrics and dividend safety scores, just in terms of a comparison of companies in the same industry, we have Coca-Cola, Pepsi, Monster Beverage, Dr. Pepper, and a few others that we see here. Well, year to date, as we mentioned, Coke is down. We can see here 14%. This is the total return, so it includes dividends reinvested. We can in fact see it is probably the worst performing of the essential competitors, in line with Dr. Pepper. Not the greatest that you want to see. And over the last 5 years, when we look at essentially 5 years worth of data for comparison for the total return again, we can see it hasn't been one of the better performing. In fact, it's been the second worst, just below FMX, with the highest being Monster Energy. So again, whilst we look at historical data, it doesn't necessarily indicate future performance, but I always think it is good just to have a look and just to understand how it has fared in comparison, as we can see, to its competitors. So now jumping straight into the dividend safety and the supporting financial metrics. Dividend safety score 8, making it safe. Market cap 230 billion, mega cap company. Now, for those that believe a recession is looming, which seems to be quite a lot of people, recession dividend, they increased the dividend in the 07-09 recessionary period. Recession sales, negative 5%. Interestingly, for those that don't know, that was above the average growth rate of companies in the S&P 500, which was in fact negative growth. And recession return, again, negative 31%, very poor for any return on investment. But if you want to bear in mind, the S&P 500 from the same period returned negative 55%. So a bit to chew on there for investors. And then we move on to the dividend growth. First, straight away, let me tell you, they've been paying increasing dividends for over the last 60 years. Because they've been over 50, they gained dividend king status. And bear in mind, they have been paying dividends for over 103, well, essentially 103 years without a reduction. Now, their growth, what does it look like? Now, 4.5% increase in February this year, 4% on average over the last 5 years, and 8% over the last 20. So one thing I just want to explain for new essential subscribers, new people to the channel, you want to be aiming for 4% increase in your dividends, salary, other income producing assets at a minimum. The reason for this, the US inflation was 4% over the last 40 years. Anything less, you are taking a pay cut and losing purchasing power. So do bear that in mind. Now, in terms of dividend yield theory, what does it state? Well, it says a company is undervalued when the current yield sits above the 5-year average, 3.46 versus 3.06. We have our first sign of undervaluation. However, remember, we never look at any model in isolation, and we'll draw a conclusion towards the end of the episode. Likewise, forward PE at 19.6, below the 5-year average of 24.2, another sign of undervaluation. And in comparison to the sector PE of 17.7, Coca-Cola is 19.6, slightly higher. As I mentioned at the beginning of the episode, it is right there at the 52-week low, but do bear in mind, 52-week low does not signal undervaluation. Likewise, 52-week high does not signal overvaluation. Earnings versus free cash flow. Now, new essential subscribers to the channel will need to understand earnings. We tend to ignore. The data is there if you want to see it. The reason that we tend to essentially ignore it and focus on the free cash flow, earnings is susceptible to manipulation by management through accounting. So free cash flow is essentially more accurate. I'm going to point out right now why. If you look at 2017, you would have seen 77 payout earnings for Coca-Cola. You would have said, okay, that's decent. It's around 70, 60, whatever metric you look for. However, free cash flow straight away, what this signals to me, 119% means they are paying out more in 2017 in dividends than they generated in free cash flow. Straight away, this would have been a red flag indicator. And again, another one in 2018. So that's just one reason why we tend to look at the free cash flow. Now, personally, what do I like? Around 60% or below is what I seek in investments, because for me, it means management are able to essentially offer those double-digit dividend growth that we love to see. But with a company like Coca-Cola, which is a more mature company that essentially pays out quite a large portion, I would say around 70% is fair enough. However, note for the majority of this period, it has been above 70%. 2021, it was below at 64. 2022 was 80%. 2023 is expected to be 75%, so closer to the 70% that I look for. But again, do bear that in mind with this type of company. They are paying out the majority of their free cash flows in dividends. Now, earnings per share, again, data is there for investors that want to look at that data. 2013, though, the free cash flow, 180, and 2022, 220. So we can see whilst it has increased over the last 10 years, we can see that, in fact, it hasn't been smooth sailing. It hasn't been increase after increase. We can see a period where it was in decline before picking up. So do bear in mind that, one, there are inconsistencies with the free cash flow, as well as the fact there aren't consistent increases year on year, and it is expected to essentially have years where it does decrease. And we can see 2023, however, is expected to increase to 247. So positive to see. As I mentioned, sales growth 3 to 7% is what we look for. And bear in mind, if they're not increasing by at least 4%, which was the US inflation rate on average, in real terms, they are in fact decreasing their revenue. And what we can see, 2013 to 2018, they're just decreasing their revenue year on year. Very, very bad to see, essentially, as an investor or potential investor. We can see a few years of increases, but again, bear in mind, Coca-Cola is a mature company. They're not innovative. They don't have essentially different revenue streams which are going to increase the business over time. They are a mature cash cow, in my opinion. 2013, 47 billion of sales. 2022, 43 billion. So it is in fact decreasing over the last 10 years. So again, just understand this as an investment. Now, shares outstanding. I love it as an investor when companies do share buybacks, returning excess cash to our pockets. But again, do bear this in mind that Coca-Cola don't really do share buybacks that consistently. 4.51 billion in 2013, 4.35 in 2022. There isn't that much movement over the period, so not much to discuss there. ROIC, return on invested capital, one of my 7 golden dividend metrics. If you want to see the other 6, check the pinned YouTube video. What I personally love to see is 10% plus. Gives me faith management are able to effectively allocate that capital. What we can see for the large part, it has in fact been above 10% every single year. Very positive to see, and it is consistent, so I do like the ROIC for Coca-Cola. Operating margin and free cash flow, you will be surprised at the number of companies in the consumer staples industries who do not hit these targets that we have here. So very positive to see that Coca-Cola consistently hits those operating margins. In fact, it has been increasing over the last 10 years, likewise with that free cash flow margin. So very, very positive for Coca-Cola. Now, net debt to earnings before interest, tax, depreciation, amortization. Sometimes I would flag this if there was a lot of debt that was increasing with the cash remaining stagnant or reducing. But with Coke, as we saw, their cash and total debt position had remained essentially the same over the last 5 years. Typically, for the consumer staples, we look for a number of 4, essentially signaling the number of years it would take the company to pay off all their debt net of cash on hand. It's been below that every single year, and in fact, in 2022, 2.19, with 2023 expected at 1.78. Very positive to see, no real issue, and personally, in my opinion, from the data we've seen, that dividend is very safe. Net debt to capital, purely showing us on the right the percentage of a company's financing from debt as opposed to equity. Now, moving on to the valuation model. As always, if you are enjoying the content, value is being provided, smash the like button. It really helps the channel, and hit that subscribe and bell button if you want to essentially have these videos dropped to your doorstep every single day. And as always, if you want to grab a copy of the valuation model to run your own companies through to get your own intrinsic value and acceptable buy price, do click on the pinned comment below and grab a copy. So typically we have here Graham's valuation. We have the stock ticker Coca-Cola, the earnings per share at 242. The growth rate per analyst estimates at 9, and that current yield on AAA corporate bonds at 5.41. Now, Graham's valuation isn't typically one that we will use for Coca-Cola. Again, it's one that you can exclude from your valuation. But in this case, I'm just showing you how essentially it's done with the formula up here. This would give an intrinsic value for Coca-Cola at $31.49. So the first model we're using is the multiples valuation model, companies in a similar sector and size, which we ran through when we were comparing their total return over the last 5 years and year to date. Pepsi, Monster Beverage, Dr. Pepper, stock price, earnings per share, P multiples, average, multiply by that by the earnings per share of Coca-Cola to get a stock price of $75 based on the multiple valuation model, showing some very strong upside to the current trading price and above that 52-week high, showing signs of undervaluation in the current market. Do bear in mind though, we never look at any of these models in isolation and will draw our conclusions at the end of the episode. We then move on to the dividend discount model, the yearly dividends for Coca-Cola Company. We have the average growth rate at 3.36. Now, forward looking, maybe a bit optimistic. You could argue I have gone for around 4.75, which has been the average of the last 2 years. Again, if you believe a higher percentage or a lower, depending on your investment thesis, grab a copy of the model in the pinned comment below and run your own figures through. However, based on this, we get a DDM price just shy of $60. Again, upside to the current trading price based on this around 10 to 12%, and again within that 52-week price range. We then move on to the third and final model, the DCF model, discounted cash flow, where we have our free cash flows year on year. Average growth rate of 4% over this period, analysts estimating 8% forward looking. With that discount rate, we get the present value of future free cash flows and terminal value. Add that with the cash, subtract total debt, and get to our equity value. Divide that by the shares outstanding, we get a DCF price of $56. Again, there's still some upside, around 5 to 6% based on the current market value and within that 52-week price range. So our intrinsic value is essentially the average of the 3 models that we've just run through. And again, if you do enjoy the content, value is being provided. Smash the like button, hit the subscribe button if you haven't already to join this lovely community. So the intrinsic value coming to around $63.47. Now the current price is $53. It has been battered over the last few days. Now, is there time to make is there an opportunity to be had here? So 10% margin of safety is what I'd recommend if you believe it has a wide moat, strong financial metrics, good forward-looking data. Your buy would be up to $57. Now, those looking at 15% would be looking for a buy essentially up to the current price, $53 to $54. Me personally, for Coca-Cola, I will be adding this to the portfolio. It is a reliable dividend payer, so it is a good one to have in your portfolio. Doesn't necessarily have to be one where you have a large allocation to. And personally, I won't be looking to have a large allocation, but it is a good, reliable one to have. So around 20% is the margin of safety I personally would be looking for. So I will be looking to add this around $50, 50 to 51. But as always, let me know your thoughts in the comments below. Are you looking to add Coca-Cola? Are you looking to sell? Or purely on the sidelines speculating? In terms of Wall Street, well, they forecast some very strong upside to the current price over the next 12 months. They see it around $70 to $71. As always, like if you really enjoyed it, value is being provided. Subscribe if you haven't already. And don't forget, if you do want to grab a copy of the model to run your own companies through, or if you want to run Coca-Cola again based on your own estimates, do click on the pinned comment below. As always, drop your comments below. Have a great day and catch you on the next episode. Goodbye.